Enough. And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Tuesday edition of The Real Investment Show. That's right. Then, of course, John Penn joining me today as well. Talk a little bit about the markets, what's happening with the economy. Of course, the Fed starts their two-day meeting today. This morning, futures kind of waffling a little bit after the last couple of days. Just kind of anticipation, not knowing what the Fed's going to say tomorrow after the bell. So, it's going to kind of be just kind of a wait and see moment. Could the Fed come out tomorrow and say, well, we've changed our mind, inflation is too hot, we're going to hike rates? That's probably not going to happen, but again, the market's just kind of hedging some bets here over the next day. So don't expect a whole lot of movement, probably a lot of sloppiness. We do have a lot of earnings today. We've got Eli Lilly, AMD, quite a few others out today. Again, we're right in the heart of Q1's earnings. So by the end of this week, we have Apple on Thursday. Oh, Amazon is also today as well. I knew there was another big one today. So yeah, Amazon today as well. So lots of big mega cap earnings this week. We'll have about 80% of the earnings completed by Friday. So again, most of the S&P will reported. So far, earnings have been good. Of course, as we talked about before, we lowered the expectation going into the quarter. So of course, we have a high beat rate. But earnings surprises have been a little bit higher than normal. If you look at the dispersion of earnings surprises, we've had quite a few companies surprising to the upside. Again, not really surprising. We lower the bar. It was like, oh, look, they beat it. Surprise. That's the way the game is played. But anyway, everything's good right now. Also, the blackout window, something we'll talk about this morning a little bit, that's about to reopen. So corporations can start to buy back shares. And again, this is kind of the subject of today's article on the website. And John and I will talk about it here just in a minute after the first segment. But we'll kind of get into why this current correction is likely over. I'm getting a lot of emails from people talking about, well, there's the yen and this and that, and probably Mike and I will touch on the yen on Friday. But the yen's been having a big crash. And everybody's kind of looking at the yen going, oh, this is the game changer. The yen's crashing. Well, first of all, the yen's crashed before. And if you look at the yen relative to the U.S. dollar, which is what we're talking about, it's crashing relative to the dollar. It doesn't really have a lot of impact on the markets. There's not a lot of correlation. It crashed back in 2001 and 2. That coincided with the dot-com crash. And yes, there was a correlation between the crash in the yen and the decline in the markets. It crashed again in 2009, 10, 11, 12, and the markets were going up. So again, there's not a lot of correlation here. So again, to try to take some bearish headline and related over to this is going to be the game changer for the markets, that's a tough call to make. I'm not saying it can't. We certainly should never just completely discount anything going on in the world and just say, oh, just go buy stocks. But this is one of those issues that really doesn't have that much of an impact theoretically on the financial markets itself. So again, it's certainly worth watching. It's worth paying attention to, but just be careful letting headlines kind of drive investment decisions. What's going to be driving the market right now more than anything, and this has been the case since 2000, corporations have been the net buyer of equity since 2000. So again, with that window opening back up, you're going to have a lot of net buying for corporations. Google just announced a $70 billion buyback. So, there's another. This year, we're slated to buy over $1 trillion worth of equities by corporations just this year. So that's a lot of net buying to help support markets. Also, earnings have been good. So there's really a lot of support here for equities, at least in the short term. We went through this correction. We got the markets oversold. We're not back to overbought yet. So again, that support is still there. Now, we're going to probably have a bigger correction at some point this year, but I would suspect that's going to be closer to the election, as we talked a little bit about yesterday. So again, in the near term, we're likely to complete this. It doesn't mean we certainly can't come down and retest some support. But again, just, a lot of this will depend on what the Fed says on Wednesday. We've got the employment report on Friday. If inflation starts to ease over the next couple of months, which is expected, then if inflation comes down, that's going to provide more support. If the Fed cuts rates, that's more support. There's a lot of underlying supports for equities in the markets right now. So again, just my point is not to be ignorant of risk, because there's certainly a lot of risk out there. But also don't let just really bearish headlines dictate your investment portfolio. Because again, what's our job? We have one job. What's your job? I have one job, make money. That's our job every day, is just to try to make some money as best we can. Doesn't mean we're going to do that every day successfully, but the goal is to do it more often than not. So, all right, let's talk about what you need to know before the bell this morning. Because again, as I said, futures are down just a little bit. NASDAQ futures down about 13 points right now. So again, not a lot. We've had two really good days in the markets. We had this, kind of 6 days of just exacerbated selling that went on, took us down to the 100-day moving average. And you'll remember, as we talked about earlier, back in March, we talked specifically about this market was getting very elevated, it's getting very extended. And what was driving this market up was the fact that sellers live higher. And we discussed the fact that in order to drive prices higher, you get to the point where sellers go, I don't really want to sell my position. And buyers go, I'll pay you more for it. And sellers go, okay, fine, I'll sell it, right? So sellers always live higher. So that's what drags prices higher. And we said the problem is that if there was something that triggered selling in the markets, that buyers lived a good bit lower, and buyers were living somewhere right around 5,100-ish, 5,000-ish on the index. That's where the volume gap was. So again, very quickly, when the market opened up on a sell decline, those buyers were like, yeah, we'll buy from you, but it's going to be down here. And so there was a lot of sellers that all of a sudden emerged that said, hey, I want to get out at these higher prices. So they all wanted to sell at the same time. Buyers said, fine, I'll buy it, but I'm down here. And so markets went down to that level where there was good buying support, lots of volume previously there. That was the 100-day moving average. Since then, we've had a bit of buying here. It's taken us back to the 20-day moving average. In fact, we closed above the 20-day moving average yesterday. So all that's good right now, but we're really challenging this 50-day moving average currently, which is the big test, and we're probably going to probably fail that today. I wouldn't be surprised to see this market pull back a little bit ahead of the Fed meeting tomorrow. Again, any type of announcement that doesn't really, I'm not expecting anything from the Fed other than just kind of the reiteration of what they've been saying. But if they say something that's perceived much more hawkish than not, we can certainly come back down and try to retest that 100-day moving average. That is certainly possible. But if the Fed does kind of come along and say, yeah, we're still planning on cutting rates, delivers a kind of a down the middle type approach, I wouldn't be surprised to see this market try to move on up here back above the 50-day moving average over the next couple of weeks. Again, we're very close to a MACD buy signal. We're not overbought yet. So again, there's potential here for this market to kind of move up a little bit higher. And then as we'll talk about, we're very close to that buyback window opening back up after this week. But good earnings from AMD or Amazon today, Apple on Thursday, could certainly lift this market higher. Again, this market is solely about earnings right now, at least for this week, and of course the Fed meeting on Wednesday. So, all right, that's what you need to know before the bell this morning. Got a lot of stuff to get into. We'll talk a little bit more about the drivers for the markets and this kind of what coincided that provided the support here for the markets near term. And again, we're talking very short-term stuff. Right? This is what the market's doing this week, next week. Outside of that, it's all a big guess. But anyway, we'll come back after the break. We'll talk about that with John Penn right here on the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just before the show started this morning, John and I and Brent were talking a little bit about the Astros this year. And Astros trailing a bit, right? Not doing really good this year so far. But we just said, hey, you know what? If the teams that are in the league just lose a bunch of games, then we'll be right in the hunt, right?
We are. Hey, there is look, y'all. There is still time.
There is
the
still
season is young.
It's like, well, the reason I bring this up is our conversation is because I just want to wish my daughter good luck today so my youngest daughter is on the Cinco Ranch here in Katy, Texas. It's a high school called Cinco Ranch High School, and she's on the dance team for Cinco Ranch, and she is trying out today to be colonel, which is the head position on the dance team. And she's really very good, and she's got a tough competitor, which is also her friend, right? And so they're both trying out today for colonel. And I offered last night, I said, hey, for a small fee, I could pull a Tanya Harding on your competitor. A lot of people are looking up Tanya Harding right now. It's old. It goes way back. But I made the offer, and she just looked at me with this kind of confused look, and I'm like, kneecap.
Does your friend drink coffee?
Exactly.
There's a little turbo lax for that.
So anyway, but I just want to wish you good luck. I love you. You're going to be fantastic. Don't worry about it. She's been very stressed about this all night, so she's been working out very hard for this. So anyway, I just wanted to wish you good luck. So a couple of things. So it's very interesting about investors, and like I said earlier, kind of our job is to make money, right? So we invest in the markets, and it's very interesting that people take on this very negative view about everything. So whatever I can find is negative, that's the thing. And it's very hard to make money in the markets if you're always negative, right? Because it's hard to invest if you have a real negative bias towards everything that's going on in the world. It's the debt, it's the deficit. You'll remember just a few months ago, Mike and I were writing a series of articles about the death of the dollar. That was the headline, right? The dollar's dead, and because of the debt, the deficit, the dollar's going to keep going down, and we're going to lose all of our purchasing power. And now it's the yen. Because why? The dollar just keeps going up, and the dollar is very strong relative to the rest of the world. And so, these narratives, they're great, right? But they really don't have a lot to do in the near term with what goes on in the markets. Yes, eventually, someday, we'll have another financial event of some magnitude, whether it's another .com crash or whether it's a banking crisis. Maybe the next crash is the AI crash, right? Because there is a lot of similarity right now between the AI chase and what we did with the .com chase. Now, there's also some differences. First of all, these companies make a crap ton of money, and that's a financial term. Compared to what the .com companies, John remembers back in 1999. I know he was young; he was still in diapers at that time. But
I was in the business in diapers.
But he was, yeah, exactly.
I remember those days.
He was the E-Trade baby.
Shh, that's just between us. Come on.
So, but John, you remember these companies that were coming out, like they had no revenue, they had no game plan, no nothing, but they put .com on the end of their name, and stock would just go to the moon, right?
It's like landscapers.com.
Exactly.
Or anything. But I remember, so I was back at Schwab during those days, and there were lines out the door to open up new accounts. E-Trade. That's it. I was the E-Trade baby.
Yeah, exactly.
That's right. Sorry. But there were we couldn't keep up with the demand for accounts. There were lines, standing room only at that time.
It really was.
Mm-hmm.
But and that's a huge difference. We're seeing a big rush of account openings again, right? Especially with younger investors. But it's not standing outside of a Schwab office to open a door. It's now getting on their phone to open a Robinhood trading app. So we're seeing a lot of accounts being opened. A little different this time. You just don't see them, see the bodies in the streets. But again, it's that same type of AI chase. But again, AI companies they make billions, right? NVIDIA, AMD, these companies are making billions upon billions of dollars in revenue. So there's a big difference there. But nonetheless, there's certainly a chase that has pushed valuations that are unreasonable, even for AI companies. And the question is whether or not they can grow into those. So again, the next crash may very well be the AI crash at some point. And we'll go, well, yeah, it was kind of ridiculous to put 40 times price of sales on NVIDIA. So it's not surprising the stock crashed 50%. That's a very real possibility at some point. But a lot of these other narratives that run around from one day to the next almost is like, it's the yen crash, it's the death of the dollar, it's this. It's the deficit, it's whatever it is. Those aren't necessarily what's going to drag the market down. Now, they could, right? Something could emerge from that causes a chain reaction through the financial markets, and primarily that would be a credit-related event. So again, what you're really talking about, we're talking about death of the dollar, the yen crash, whatever it is. You're talking about something that opens up a credit-related event, something that destroys the underlying function of the credit market and how it operates within the system. In other words, we wake up tomorrow morning and you have to make the argument that the yen crash is going to lead to an event where banks no longer trust other banks to trade with because John's Bank A right? And he's got a whole bunch of yen on his books, and I don't want to trade with John because he's got too much yen exposure. Maybe that's the case, but that's the argument you've got to make, right? So in the near term, we've got to focus on things that actually drive the markets, and that is earnings. And right now, that's corporate buyback. So again, this is what I was talking about earlier. And over the last 2 weeks, and so go back to March the 19th. I wrote an article talking about the blackout of buybacks, and that could lead to this 5 to 10% correction in the markets. And in 2 weeks, we went from being extremely bullish. In fact, if you look at the net bullish sentiment index, which is the index that we run here, it's basically net bullish sentiment of both retail and institutional investors. That was at 38, which is a very high level. And in 2 weeks, it went to 9. So there's been just this little 5.5% correction. We've had a very, very sharp reversal in bullish sentiment. And so that's a good thing, right? So for the market, what you want is you want people to get negative because, again, markets run on a contrarian basis. So when everybody's bullish, that's when you want to sell. When everybody's getting bearish, that's when you want to start buying stuff. And, not surprisingly, we've gotten bearish and, kind of right on cue with the drop in the market. So again, the phones were, previously in February, March, our phones were ringing like, get me in. And now it's like, shouldn't we be selling? Mm-hmm. Right.
Earlier you were talking a little bit about kind of our role in this to make money.
Yeah.
Right.
Yeah.
Well, and I think there's another role too that we have, and that's for us to help you kind of keep your emotions in check out there.
Yeah.
Right. Because because the narrative, all these market headlines and the narratives, I mean, it makes that pendulum of emotion swing so widely from right to left all the time. I mean, going back and talking about, events that will kind of be negative or keep somebody or prohibit somebody from investing in the market. I mean, still to this day, I can't tell you how many folks I visit with, Lance, that they got out in 2008.
Yeah.
It's 2024. They're still not invested.
Right.
Right. Because of all of that negativity and all that fear out there.
Yeah.
Right. I mean, it is real. It does affect you emotionally, but I mean, think about that. All the opportunity that was missed along the way.
And that's really kind of a key point. I've talked about that before, John, which is, if you ever meet a business, anybody that owns a business, right, that runs a small business or medium-sized business or a big company, whatever, if you meet somebody that owns a business, they're always optimistic, right? It's like, yeah, it's a tough month. Sales were tough last month, but next month is going to be better. They're always optimistic. And the reason they're always optimistic is that you can't be pessimistic and be in business. Because if you're like, oh man, sales were terrible and sales are going to be worse next month, I should probably close down, right? So if you're super bearish and super pessimistic, you're going to close up your business. And that's why business owners are always optimistic. And it's kind of a way to look at, your portfolio. If you're always pessimistic about everything, you're going to wind up missing a lot of opportunity. And, we've talked about before, John, that, more people have lost more money trying to avoid the crashes than actually being in the crashes.
Oh, sure. Yeah. Absolutely. Yeah, it's to their detriment. You try to outthink it, and that's usually when the market will kind of take you to class a little bit, right?
Yeah. So let's talk about a couple of reasons why this current correction is probably close to over. Again, it's probably not over yet. We've probably got another little bit of a downdraft here. And there's certainly some reasons that, maybe in the short term, it could go a little bit lower than we expect. But again, there's a couple of kind of overarching reasons why whatever correction we're going through is likely going to be over sooner rather than later. And again, we're still in the seasonally strong period of time. So we're just talking now for the next month or two or three, right? So we're not talking about the next 5 years. We're talking about the next few months because, as I said yesterday, we kind of went through the seasonality yesterday of presidential election cycles, and I do expect a bit of a correction again this year prior to the election. It's a little bit early right now to have a correction going into the election. It's too drawn out. So we'll probably have this correction, another rally, and then a correction going into the election, then a rally into year end. That's kind of the baseline of presidential election years. They don't always work out that way. But when we come back from the break, we'll talk about a couple of factors in particular that have aligned with this current correction and what will likely kind of drive the next advance in the short term. Don't go away.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Part of the problem of the average American is that we've just chosen to live well beyond our means.
Basically, you can buy anything you want out there on a payment. You need new underwear? Go get it on a payment plan.
Underwear can be expensive. If you buy some Jimmy John's, they're not cheap.
Jimmy John's.
And
Sandwich
the point
underwear?
is,
What is this?
But Tommy John's, thank you.
The Real Investment Show podcast.
That's why I just don't wear underwear. It's too expensive anymore.
At realinvestmentadvice.com.
Going commando is going to become a new thing for the poor people.
It's going to be a...
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I'm going to move pretty fast through a couple of screens, a couple of slides here just real quick because got some other topics to get into with John this morning. But just there's two big reasons why this current correction is probably close to ending, at least at the moment. And again, doesn't mean we're not going to have another one this year. Just, this current sell-off is likely going to be fairly mild, and we're going to have another bit of an advance here. One of the reasons, of course, is that earnings are improving. Quarter one earnings are coming in stronger than expected, and estimates this year are still pretty high. And that's corresponding with an increase in the monetary supply. So M2 is on the rise from fairly low levels, by the way, but just it is on the rise, and there is a correlation between contraction in monetary supply and increases in money supply in the markets. And again, we talked about this. One of the big drivers over the course of the next few weeks is this massive $1 trillion sitting in the TGA right now, the Treasury General Account, that's going to flow back into the economy on spending, and will also require less Treasury issuance. So there's this impulse of money in the system. Secondly, earnings are rising in anticipation of Fed rate cuts. So again, when the Fed cuts rates, earnings are going to get a further boost because you're lower borrowing costs. So as the Fed cuts rates, borrowing costs come down, which improves earnings and margins. So that's another reason. But look, the best reason to pay attention to earnings is that you normally, historically, don't have corrections of more than 10% when earnings are increasing on a year-over-year rate of change. And so that is occurring now. So earnings have troughed out in October of 2022. We've now had year-over-year rates of change in earnings that are growing, and historically drawdowns in markets are fairly small, 5 to 10%, during periods where earnings are growing on an annualized basis. Of course, now the biggest reason, as I said a minute ago, is the fact that corporate share buybacks are coming back into the market. Since 2000, if you don't believe the math, here's the math for you. Going back to 2000, corporations have made up 100% of the net purchases in the market. So if you just if you do the math here, right, pensions have a net drawdown of 2.2 trillion. Mutual funds have had a net draw of about $0.5 trillion. Households have bought 0.6. Foreign investors have bought 1.8. Corporations have bought 5.5 trillion. So if you just kind of do the math on this, right? If you take out the negative 2.2 trillion and the 2.4 trillion, the 2.7 trillion of pension funds and mutual funds, those first two columns, you add in the 2.4 trillion of households and foreign investors, that's a net of negative 0.3 trillion. So outside, those just offset each other. So that's a net neutral on purchases of equities by those. So the total 100% of the net equity buying outside of that is all corporations, right? And so this year, we're slated to have over $1 trillion of that. But this current correction is important because, again, that coincided with that blackout window, and we had a $367 billion drop in share buybacks. So the only buyer of equities left. they left the party and went home, and they're just now coming back to the party. I guess they had to go get a 6-pack of beer, right? They had to do a beer run real quick. And so we had this 5.5% correction in the markets. And so corporations will return back here in the next day or so. So when they do that, of course, what spurs equity buying is improving earnings. And as earnings improve, CEO confidence improves, and CEO confidence has been improving. And so as CEO confidence improves, so do net buybacks. And the reason for that is that when CEO confidence is not great, they tend not to want to spend money on share buybacks. And when it improves, then like, okay, everything's fine, earnings are good, outlook's good, we'll buy back shares. And again, this is why I saw Google announce, again, a $70 billion additional buyback. They're already buying back shares. They just added another $70 billion to the pile of buybacks. And again, look, and as you all know, I'm not a big fan of buybacks. It's the least best use of capital for corporations. Instead of doing R&D or buying another company or expanding plant and product, hiring more people, putting more, giving pay raises, all that type of stuff. Buybacks are great only because it helps lower the EPS, the number of the share count out there. When you're looking at earnings per share, you have fewer shares, so earnings improve. And also, that's how insiders of companies monetize their share issuances, right? So this is why we have this big gap in wealth. But so I've written plenty of articles. If you go to our website and just type in the word buybacks at the top of the website, you'll get tons of articles we've written on the fallacy of buybacks. It's not a return of shareholder capital, but it does boost stock prices in the short term. So, but those two reasons, earnings and buybacks, are likely going to limit this downside, at least in the near term. And again, we got a whole other bunch of issues coming up prior to the election. We'll worry about that when we get there. So, John, any comments real quick?
Yeah. So, just the whole share buyback, it goes to that quick boost in earnings per share, right? It's kind of going back to that instant gratification society. It's just an easy way to boost your earnings real quick, right? But you mentioned, through that discussion, a point that, really stuck out to me is, when you had the lesser of that buyback activity, you said we had a market correction of downward of 5.5%.
Right.
5.5%.
Yeah.
That's it.
Yeah.
To me. I mean, it felt a lot worse than I think what it really was. And I think as investors, I don't know if we're really, we're so used to having kind of little volatility as of late. Like the market to me seems a little bit complacent out there. So 5.5%, it's like, I mean, is that really is that a huge deal, really?
Right. No,
in the grand scheme of things?
It's not, but when you go back and look at so here, let's just go through the last year real quick, right? So in February, March, April, May, June, July of last year, right? We had the AI chase. And I wrote a couple of times that, hey, we're going to have, we got into June, July, we said, hey, we're due for a 5 to 10% correction. And when we get that, it's going to feel way worse than it actually is.
Yeah.
Right? Because it's just, we've had this nonstop advance. We're up 17% in July for the year. And so you have a 10% correction. We're like, this is going to feel really bad. And of course, when it came and we had it right on the nose, 10% correction in October. By the end of October, it was the end of the world. Bearish sentiment was as bearish as it was during any major market crash. And people were like, oh my God, this is the bear market's back. It's terrible. And it was a 10% correction, which is completely normal for any given year. 5 and 10% corrections happen every single year, right? Every year you're going to have a 5% correction. Every couple of years, you're going to have a 10% correction, like clockwork. But when you have these, John, to your point, though, when you have these periods of just very low volatility, the market's just grinding higher. We went for 4 months, we went without a single day of having more than a 1.5% correction in the market. I mean, just very low volatility. So everybody's very complacent. It's very easy. Just, I start getting Facebook posts, how to make money in the market. Just throw it in the market. It goes up, right?
Literally, yeah.
And so when you have these corrections, they feel so much worse than they actually are because you just had this very low volatility rise, can't lose money. All of a sudden, you're losing money every day, especially when you're down 6 days in a row.
Yeah. Yeah, it's just interesting sometimes, and we all visit with a lot of folks, and it's amazing how just that exuberance, the emotions can really swing out there, even with like, well, I'm an aggressive investor.
Yeah.
I'm an aggressive investor. And then all of a sudden, I mean, as of right now, from the recent peak at the end of March to where the S&P closed yesterday, we're down about, 3%?
Yeah, roughly.
Roughly?
Yeah.
And, folks start getting a little worried about that. It's like, well, hold on a second. Let's just take a step back here and let's really look at what type of investor are you, and what sort of guardrails, what's the best way to manage the portfolio here moving forward from a risk standpoint, right?
Well, again, and you've got to expect, and that's the thing, is that when you're talking about risk management, it doesn't mean no risk,
right? Because
if you want no risk, you're in cash, right? So you've got to expect volatility. You've got to expect a drawdown. You just want control. You just want control over it, and so you've got to expect the market to ebb and flow. And look, and pullbacks are great. We use this pullback to buy Eli Lilly, which just reported earnings this morning. Stock's gonna be up 7%. It's great, but you've got to be willing to step in and buy these dips. And we were talking about that in February and March. We reiterated that several times. Like, rebalance your portfolio, take profits and big winners. We sold a little bit of AMD and Nvidia earlier, raised a little bit of cash. And we've added back to those positions now on this decline. And that's the management of your portfolio that you want to work through, is look for sell-offs. And we actually had a comment in our YouTube chat this morning just talking about, when you want to throw up, that's when you start buying. And that's true. I mean, when you're sick to your stomach, that's when you're like, okay, I got to go buy something. And that's very hard to do, but that's the contrarian way that the market works. So when you're super exuberant about everything and you think that markets just cannot stop going up, sell some stuff, right? And again, doesn't mean sell everything. We own NVIDIA. We sold it down a little bit. We still own NVIDIA. Waited for the correction. We added back to it. So again, it'll correct again at some point, and we'll probably buy some more, but that's just the way it works over time.
Yeah, it's amazing how there's the mentality of, as markets rise and things get higher and higher and higher, it's that fear of missing out. It's like we're going to chase returns, and all of a sudden markets have a pullback. It's like, oh, hey, but now things are on sale. They're at a better value. Are they at the rock bottom? We don't know.
No,
but at least we're going to try to nibble and get things at a better value than where they were before.
And look, and eventually someday we're going to have a really decent correction. We're going to have a 20 or 30% correction at some point, and that'll be another really great buying opportunity. But there's no way to tell when that's going to happen. It could be a month from now. It could be 5 years from now. it'll happen, right? Guaranteed. Just what drives it, what causes it to win.
Mm-hmm.
All right, quick break. We'll come back. We're going to talk about the perfect investment. Does it exist? Got a great email question about this earlier this week. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
What are you doing over here?
Well, we got busy talking during the break.
Well, just because we're talking doesn't mean you're not supposed to be doing your job over there.
Well, I have to listen to what you were telling me.
Mixed master.
I was actually talking to John. You were just eavesdropping.
Unfortunately.
All right. Anyway, so every now and then we get, emails or we get, prospects that come to us and they have specific investment needs. And it's always very interesting to see some of these because, in all some kind of shape, kind of some form or fashion, they want the perfect investment. And John, you got an email this week kind of in that same vein, kind of wanting this perfect investment vehicle. And the question is does one actually exist?
Yeah, and actually the question is a great question. It's so here were the criteria or the characteristics that he was asking for. And so looking at 4 characteristics: wanting an investment that could guarantee a 4+% return, right? Mm-hmm. If there's a liquidity need, be able to withdraw cash if needed, so have it be liquid where they can withdraw funds. Any sort of income, any sort of income that the investment generates, have it roll back or reinvest back into the fund if it's not needed. And if interest rates should drop, if yields drop moving forward, mm-hmm. is there a way to participate in some price appreciation potential, sure. right? So get all of those 4 characteristics within one investment,
yeah.
right?
And actually when I first read that, I was like, buy a 10-year treasury.
Yeah.
right? Mm-hmm. And I was like, okay, because you're going to get 4% plus. So your lock-in rates.
You can get north of 4% locked in with the 10-year right now, sure.
And you can sell some. Bonds are highly liquid, so if you need to sell some of your bond for cash, you can.
Yep.
Right? You can reinvest the interest rate that it pays back into buying more bonds.
Sure.
And if bond yields drop, they go up in price. So I read those 4.
Yeah.
Right? I'm like, oh, that's easy.
It was close.
I was like, that's easy. Just go buy a 10-year treasury. And then I read the rest of the email.
Yeah.
The rest of the email says, additional note, I also want the investment vehicle to keep the dollar amount invested stable with no price fluctuation.
That's it.
Right? So I want something so now I'm down to money market.
Yeah.
Right? Because why? Money market pays north of 4%.
Right now it does.
Right now it does. Right? I can take money out when I need it. I can reinvest the proceeds back into the money market account. It has no price variability. So money market.
Yeah, because at first too, I was thinking about even maybe like a longer duration, like an ETF, right?
Right.
But there,
price fluctuation.
So you've got liquidity,
right?
But you don't have price stability.
Yep.
Right? Because as interest rates move, well, the price per share will move. You know, if you need liquidity out of it, let's say if interest rates are going down, that's to your benefit.
Right. So what about something like a indexed annuity?
Well, so I thought about annuities too, right? So an annuity could give you a fixed generated rate of return, but the only issue that I could see there is a liquidity issue.
Right, because if you take money out, you got penalties.
Because, usually with annuities, within the first, couple of years, maybe it's the first 7-8 years, depending on the annuity,
Seven's a big different from a couple.
Yeah. Well, okay. So we'll say 7. So there's it's getting hot in here. But there's a surrender penalty if you start taking money out. Maybe you can take out 10% a year.
Right.
With penalty free, but that may not be enough for what you need from an income standpoint. Right. So then that kind of ruled out annuities in that aspect too.
Well, but if you could live within but just stay there for just a quick second.
Yeah.
So if I could live on 10%. Right. So in other words, I could say, okay, I'm happy with just having a 10% withdrawal availability. Then an annuity might actually fit most of that perspective because you're not going to have price variability because the annuity doesn't change in price. But if it's an indexed annuity, you could have years of return where you only have 0.
True.
Right. So you're capped on the upside. If the market goes up, that's great. If the market goes down, your return is 0.
Your return is flat that year.
Right. So you're not necessarily going to generate a 4% rate of return. Right.
Yeah.
So
and the issue is too, let's say you buy that bond. Let's say you bought the 10-year treasury and you're getting about 4.5% right now. Well, that the bond, as it pays its interest, it's not going to go back into the bond and compound at that. That money, let's assume it's going to go into the money market, which right now is paying actually a little bit north of a treasury.
Right.
But if the Fed starts reducing interest rates, that yield on the money market fund is going to drop. Right.
Yep, that's right. And I thought when I first read it too, I also thought about a whole life insurance policy, which will fulfill the first 3, right? But you don't get you get tax-free withdrawals. It'll grow at 4%, blah blah blah. But if yields go down, it doesn't change the dynamic at all. So, that it's an interesting question. And again, you can fulfill the first 4, right, pretty easily.
Yeah.
Getting a 4% rate of return in a market's not hard. Withdrawing cash, dividend reinvesting, if bond yields drop, prices go up. That's all pretty easy. It's that no price variability.
Keeping my principal stable without any sort of volatility. Yeah. And so, yes, you can hit maybe 1 or 2 or 3 of these bullet points, or maybe all 4, right? But it's that last piece where it's like, man, I couldn't find anything.
Right. Well, and again, this is because, and the reason, there's a reason, and I've written, maybe send me this email.
Sure.
Right? Because I'm going to bring up an old article I wrote about this. We've written before a couple of years ago, and it's probably just a good time to refresh this article, but talking about the 3 components of returns over time. And you can have stability, you can have capital appreciation, and you can have income. The problem is, and this is a good example of this, you can only have 2 of 3. You can never have all 3. So in other words, if I buy equities, I've got capital appreciation and I've got liquidity, but I've got no guarantee of my principal, right? So I can have losses. If I buy a CD, I can have income and I can have stability of my price, but I don't have necessarily any liquidity, right? So I can't just go sell the CD. So everything that I have, I can only have 2 of those 3 components of any investment. And the interesting part about this is that this is wanting all 3, but in in reality, there's no way to build an investment that has all three.
Right. And this email actually, this email I think it's wonderful because I think this is an email example, but we have conversations with folks like this on a daily basis, right? And it's, hey, what is kind of out there? What is available for me to invest in to help me grow my money to support those financial plans that we put together? So all of these points, I'll definitely send this to you because I thought this was very timely to discuss.
Right. No, and again, this is and again, it's interesting that this email comes in because just a couple of months ago. Right, the markets are going, and this is very symptomatic of market corrections and what goes on. Right, a couple of months ago, markets are going up, and everybody's just wanting to be in the markets, and it's always interesting because we have people come to us all the time like, if I could just get 4% of my money, I'm good. Right, and as soon as the market's going up, it's like, well, why aren't we making 7, 8, 9%? Market's up 10, I'm only up 4. Well, you said you wanted 4, so we built you a portfolio for 4. And now you're wanting 10, right? And then as soon as the market goes down, if I could just get 4, I'm good. Yeah. And this is that swing of psychology that we're talking about also. And this is what impacts investing, and this is what leads to investment mistakes over time. But this is very representative of those swings when markets are going down. This is when these type of emails show up. I want 4% with no loss of principal. But when markets are going up, it's like, why aren't we beating the market?
Yeah, why Tesla's up 15% pre-market? Why am I not in that?
Exactly.
Why is my money not on Tesla?
I'm kicking myself because I was in Milwaukee earlier this week for that investing conference. And so one of the guys that was there, I was sitting there and we were talking. I said Tesla, we were up early, so it's breakfast. And I said, Tesla's about to report earnings. I'd go buy Tesla. Yeah. And he whipped his phone out and he bought Tesla right before earnings. And he's up 35 or 40% on it. He emailed me last night. It's like, hey, thanks for the tip.
Yeah, hey, great breakfast. Thanks.
I was actually just talking. I was like, man, you should probably buy Tesla here because they're so beaten up and there's such a big short position on it. And it's almost a guaranteed win. If they just report things that just aren't as bad, the stock's going to go up. And they've had 2 good news announcements the last 2 days. So I'm kicking myself because I didn't do it. I should have done it. But I don't have any trading apps on my phone. So
yeah, I don't either for a specific reason.
Yeah, no, my wife was laughing at me last night. So my phone's getting pretty old. And I said, I'm just, at some point, I'm just going to go back to a flip phone. And she goes, well, how am I supposed to send you TikToks if you're on a flip phone?
So wait, how old is your phone? What do you have?
It's a Samsung. It's Android. It's Samsung Galaxy thing.
Oh, okay.
It's old.
Well, I thought mine was pretty old, so I was carrying the iPhone. It was a 6S.
Yeah, that's pretty old.
And even
they're up to 15 now. You're 9 generations behind.
Yeah, so even my kids were like, Dad, it's time. You need to go get another phone. I was like, why? It works fine. All of a sudden, it was having some battery issues where it would just like randomly shut off. So I finally broke down and
you got a phone.
We got the.
Well, see, that's where I'm getting to with my phone. Is that now it used to hold the charge all day, and now it's getting to be about 3/4 of the day. I'm running out of juice. So, but it's just funny because I hate spending money.
Oh, I can't stand it. Oh, I was like, no way, this phone will last. And I went in there, and I was like, the guys looked at my phone when they were doing the swap. They're like, this is a 6S. You've had this for 10 years. I said, yeah, is there a display case like a museum you can show other people like how to milk this thing as long as possible? I'm the example. I will somehow be like MacGyver and keep this together just to save a nickel.
Yeah, his iPhone's stuck together with glue and bubble gum and
whatever it takes.
All right. Hey, John, thanks a lot for the day. Appreciate it. All right, get by the website. Latest article is out on the website now talking about earnings and buybacks. It's on the website this morning. While you're there, send your questions and comments. Make sure and like and subscribe to the channel. We certainly appreciate the support. And as always, if you have any questions, comments, whatever it is, send me an email. Always happy to answer them for you. We get lots of emails every day, so happy to do it. Anyway, thanks a lot for tuning in. We'll be back tomorrow with Danny Ratliff right here on the next edition of the Real Investment Show. Have a great day.